Welcome back, Alpha Hunters. How are you doing this week? Okay, so there's been a lot of talk in the recent marketplace about interest rates rising and currencies. There's been a lot of talk about currencies also. So these are the topics that are going to be covered in this video. Now I'm going to cover them together because there's a lot of similarities to how they actually affect the value of stocks. So I'm just going to cover them together rather than making two separate videos. And we're going to do that by understanding this high-level grid. So what we want to know is how do rates and currencies impact stock prices, okay? Now this is going to be a generality video. This is not going to be like a specific, financials, that doesn't really work so much with financials. We're not going to get into that. We're talking about just general marketplace stocks. So let's go ahead and look at what happens when interest rates go higher and the currency goes higher. Well, the impact it's going to have on the stocks is actually a negative one. Stocks don't really typically like that. And we're going to get into a little bit more of a detail, that way you can understand a little bit later. But just a high level picture, interest rates going up, currencies going up, that's going to be bad for stocks. Now the opposite's going to take place, right? If interest rates go down and currencies go down, stocks should go higher. But you don't really typically hear about interest rates and currencies all that often, right? Because daily or range-bound moves, they're not going to have like that big of an impact on stock prices. But strong, lasting, and trending moves on rates or currencies will start to impact the stocks, okay? Especially if it's at a pace that was quicker than the previous market environment, okay? So if interest rates were kind of just chopping and going sideways, or maybe even they were slightly ticking up over a period of time, and then they really start to accelerate to the upside, that you will start to see the stocks respond to those kinds of moves, okay? So let's just walk through a couple examples real quick on how rates impact debt assets and bonds. And this will also help us then understand why it does affect the stock prices, okay? So let's say we have a $1,000 bond, and it'll be for 10 years. Now we don't know the interest rate payoff, so we don't know how much we have to pay for the bond. So let's say the interest rate is 2%, and that's kind of low. So we pay about $900. Now, the numbers aren't exact, but I'm just wanting you to understand the relationship here. And then let's say rates rise to 5%. Okay, so if rates go up to 5%, let's say that bond then is at $750. So we could see the relationship that goes on here. So if the rates go from 2% to 5% and they increase, then we expect the value of the bond to go down. Now, as the bond goes down in value, the payoff between the bond on which you can buy it to what the maturity would be of $1,000 starts to be a little bit more attractive to investors. Okay, so you can lock up a guaranteed 5% rather than being in the market, which you don't know what the rate of return's gonna be, but you can lock up a guaranteed rate of return for 10 years at 5%. Okay, so that's where you just need to understand why it starts to become attractive as interest rates go higher. Debt assets and bonds start to become a little bit more attractive to investors. So they could potentially leave stock assets for debt assets. And then the other way is possible. As interest rates go down, then bonds get more expensive, which then the payoff between the price you pay for the bonds, so in this example, $900 to $1,000 over 10 years, not exactly attractive. So where do you need to go to get a rate of return on your money? Most likely it's just stocks. Stocks just look very cheap at that point in time. So just understand these relationships. You don't really have to understand calculations, and that's one thing we're not going to cover really that much today is calculation on present value of debt assets. So we're not going to really look at that. And another thing that rate impact has on stock values is actually how much the future earnings is for stocks today, okay? So as we look into the future and we say, okay, a few years out, we expect this company to be making $5 per share, but then we use, maybe a lower interest rate to discount that $5 back to today's value, and we come up with maybe like a $4 per share on what was $5 per share in the future using a 2% interest rate. Well, that's pretty good. That's not bad. It's called time value of money. It's, what is the future value of a dollar today? In a low interest rate environment, that $1 in the future is going to be close to about $1 today compared to a higher interest rate environment. Okay, so if we go to a higher interest rate environment, so if we have $5 per share in the future and we use a higher interest rate, in this example, 5%, and then we can come back and get $2 per share today. So it doesn't look as valuable using a higher interest rate to figure out today's value of future earnings on a company. So this is another impact that interest rates have on stock values. Okay, done talking about interest rates for now. We'll look at some examples on some stock charts here in a little bit, but let's move over to currencies, okay? So let's talk a little bit about currencies. Currencies, it's global. So as you have a lot of companies that do business multinationally all over the world, they do business in different currencies. So we need to understand, how different currencies impacts the earnings of a company in our local currency, okay? So as companies bring in revenue from all across the world, they have to exchange out of those currencies into the local currency that they report on. Most of them do report here in the US on dollars. So as companies need to present their earnings and their financial statements, every quarter, they have to convert all of these currencies from around the world to US dollars, okay? And when they do that, when the US dollar is strong, that's actually not good for the earnings that come from other currencies. And we'll go through a little bit of a math example after this so you can really kind of see it, but just understand that a strong dollar is bad for overseas earnings. So the other side will also be true. As the dollar is weak, then earnings in other currencies from around the globe will be stronger. Okay, so real quick, just understand strong dollar means less earnings will be brought in from other currencies, and then a weak dollar means more earnings will be brought in from other currencies. So let's just go through this real quick example just to understand why that relationship is, okay? We'll look at a euro dollar exchange rate. So we'll say the exchange rate for the euro dollar is 1.3 to 1, and we'll say that that's going to be a strong dollar environment, okay? And we'll say this company has earnings in euros of 75 million, okay? And when you use the exchange rate and the euro earnings, we get a dollar earnings of 58 million, okay? We took 75 million of euro earnings and wound up converting it to about 58 million using the exchange rate, okay? Now, what if the exchange rate was a 1.1 to 1? Still using the same 75 million of euro earnings, we come up with a dollar earnings of 68 million. So we can see that as the dollar is stronger, we bring in less earnings from overseas, from other currencies. Okay, now as the dollar is weaker, we bring in more earnings from overseas currencies. So like I said, this isn't really meant to be a whole lot of calculation, but just to understand the relationships as we are trading and investing, to understand how the market will react to certain scenarios that go on with changes in interest rates and currencies. So let's switch over to the charts and see if we can find some examples. Alrighty, so we are taking a look at the SPY here on a weekly chart along with the TNX. And the TNX is this orange line that you see go through here, with the SPY being the bar charts, okay? So as we can see, we've been kind of having higher interest rates for the better part of about 2 years, from the base of the COVID bottom here around at the beginning of 2020. Now, the thing to understand about this environment that we had back in 2020 is rates were really at the lowest they can go. They couldn't really go much lower. So as they did start climbing, and as I said earlier, rising interest rates are not really good for stocks. Typically, stocks tend to go down. It doesn't always react that way, okay? It just depends on, one, really the pace of change of rates or currencies. But when interest rates are just so low, it just makes stocks look that much more discounted. So rates needed to get back to a more normal level, and so that's what we've been seeing really for much of this year. So the beginning of this year was pretty much where my cursor is now, the vertical line. And as we've seen really since the end of last year, beginning of this year, we've seen rates really start to accelerate to the upside. And then here recently, we have started to see the sell-off in the market. Another one was back in 2017 or so to 2018, where we just kind of had nothing go on for the whole year as far as interest rates. It kind of just went sideways. And then they broke out at the beginning of 2018 and kind of went higher. And the market got a little squirrely there for a little while. Okay, just right in here for about 3 to 4 months. So that was another time period where interest rates were rising and the market was really kind of paying attention to it. But like I said, it doesn't happen often, but when interest rates really do start to pace to the upside, as they have been at the beginning of this year, the market really does start to take notice of that. And it's really twofold, right? It's other investments start to look more attractive, like debt assets and bonds and stuff like that. And the future value of stocks actually starts to look more expensive, okay? But the reason why I definitely am showing this off, because it's starting to be news now and recently, but nobody's really thinking that rates are going to stop where they peaked here recently of 3.1%. People are expecting them to kind of continue to go higher. I will expect that they will consolidate here for a couple weeks just because they've been on such a large run over the past 2 months. So let's take a look at some currencies. Okay, so up on the chart we have the SPY. And the orange line this time is now the DXY, which is an ETF that tracks the dollar strength, the strength of the dollar, okay? As we've seen the US dollar strengthen and continue to rise here over the past several months, we are now starting to get to that point where it has really outpaced itself to the upside, and it took out the peak that it put in from COVID, and so that has also spooked the market. So as we've seen a lot of increases here in the dollar strength, we've seen stocks get weaker. So like I said, as long as interest rates and currencies stay in a relative pace or channel, the market doesn't really care too much. But as we've seen with interest rates and currencies, or the dollar strength here recently, we've seen really, really strong moves in both of them that are really starting to impact the market. Okay, so I want to put this out just that way you guys know how they impact the stock market, as I think this will be talked about more going forward. Alrighty, take care, Alpha Hunters.